Crypto plummeting again. What on earth have you lot been up to since the last time I delivered a market update? It seems that a huge stack of long-side liquidation risk remained and potentially re-entered into the market since the last time we checked those levels on Sunday, and that has unfortunately been realized. Look at this. I actually couldn't quite believe my eyes when I checked the markets today, because once again we are well below 90k. Bitcoin currently at a price of $86,442, but you can see that we sold off from Sunday's levels all the way down to 83,822. That is a slip of nearly 9% from Sunday's levels. And sure enough, as always, I feel like a stuck record saying this again and again, but it was driven by long-side liquidations. Nearly $1 billion worth of long-side liquidations, positions wrecked out of the market, forced to sell by the exchanges who these traders were borrowing money from, trading with money that they don't have, forced to sell out of those positions to a tune of nearly $1 billion worth. $873 million worth of long liquidations over the last 24 hours, and about $328 million of those falling within the last 12 hours. As you remember from my Sunday update, it looked like there wasn't a hectic stack of liquidation risk in the market. At least it didn't look like that liquidation risk was particularly biased to the long side. We looked pretty balanced on Sunday, but sure enough, the liquidation risk was there, and the liquidation risk was very much realized. If we look at where this is sitting right now, in fact, first of all, maybe we'll look for some fundamental reasons as to why this might be happening. CNBC here, and I've seen a few other sources also pointing towards a general risk-off attitude. We're not really seeing that reflected in the S&P. We still have, in fact, an even more elevated chance of that 25 basis point Fed rate cut at the December meeting. Once again, expect this not to change very much because we are now in the Fed's blackout period. That means that Fed members cannot speak publicly on where they're leaning in terms of a rate cut at the December meeting. We still have to wait about 8 or 9 days for that announcement, depending on when you're watching this. CNBC, and a couple of other sources pointing towards a general risk-off attitude in the markets. Do bear in mind that also this elevated chance of a rate cut came as something of a surprise, as we saw a couple of members starting to flip, including Dali, for example, last week. But that is now going to be priced in because the markets are efficient. The markets know what is happening before you've got pricing edge on this. Okay, we're not going to react in the future to this chance of a rate cut staying the same. We reacted when it changed, as it changed. That is the markets being efficient, the markets behaving in an efficient manner. But now that is priced in, don't expect this to continue being a particularly positive driving force. Obviously, if we see that dip massively for some reason, right, changing information on economic data or something like that, then that would obviously have a negative effect. But don't expect this to improve things massively, right? Even if this jumped up to 100% for some reason, right? We're basically pricing in 100% on the rate cut, which is generally good for risk assets. Not necessarily good long term, Still not necessarily looking very good long term for the state and the health of the US economy, based on essentially the limited economic data that we have there coming out, particularly in the labor markets, and the way that data continues to be redacted. Okay, it doesn't look very good. It looks, quite frankly, like they're trying to hide something. CNBC here also saying that a statement by the People's Bank of China on Saturday warning of illegal activities relating to digital currencies heaps pressure on Hong Kong listed shares of digital assets related companies, which retraced or retracted during Monday's session. This didn't seem like massive news when it happened on Saturday, although obviously it is sentimentally bad for the market, potentially the spark that lit the fire again in this case. But once again, it all comes back to liquidations. And where are we looking on those right now? Well, if we look at the one-day Bitcoin exchange liquidation map here on CoinGlass, we can see there is a bias to the long side, about $3 billion worth of short side liquidation risk versus just under $1 billion worth of long-side liquidation risk, just under $2 billion worth of cumulative long-side liquidation risk. So a balance to the short side. Obviously, when short positions become liquidated, that equates to forced selling onto the markets. But if we zoom this out to the 30-day time horizon, you can see short side liquidation risk up at $13.5 billion and long side liquidation risk at about $3.19 billion. Now, I just want to quickly reconcile this with the fear and greed index. Let's just take a bead on that. Of course, you can kind of get a feel for yourself of what the fear and greed index should be doing. We're currently at 20 on the fear and greed index. I think, honestly, this doesn't look great, okay? My last video I was talking about how it looked like the most recent sell-off was a healthy sell-off, just a gentle little nice, fun, cuddly sell-off, not liquidation driven. But clearly we did pull back deep enough to get into some of those liquidations. And you can really see this in the chart. Okay, look at the way we just came down massively in basically one or two candle bodies here. On the hourly chart, yes, but anytime you see markets moving in a very fast manner like this, it either means something massively momentous has happened in a fundamental sense, right, in the fundamental regard, big news, basically, or we've had a liquidation event, we've had forced selling. Because what happens is, as traders are forced out of those positions, as they come up against margin calls and then liquidations, the exchange literally goes and sells the Bitcoin or the crypto that they had collateralized on those positions. They go out and sell that on the open market, and that causes this massive, sudden surprise sell-off, which then pushes the price down. This is fanning the flames, right? It's a vicious cycle. It's a snowball effect, because then the price gets pushed down aggressively, and that happens to more and more people if liquidation risk is stacked up in the market. And that's what's happened here. We are bouncing fairly strongly out of the pit, I would say, which is nice to see, because it means basically we've got some market structure forming around these lows. Whereas in the last couple of weeks, we just had lower, low, lower, low, lower, low, right? A solid classic downtrend, right? Basically down and across only. Now what we've got forming is something of a bottom here, and it's nice to me, or it's positive to me, seeing how we're bouncing out of these lows. Now, of course, I'm speaking in the moment here, right? This could change. It could totally flip on us still. But I like that we bounced here at 83,900 and we didn't come back down to test the sort of ultimate local low here at $80,500. But there we go. Liquidation risk. Please manage your downside. Please don't be one of these people still in December 2025 getting wrecked on too much leverage, buying in to the dip, which I think is commendable. I think it's brave, and I think it's likely to pay off if you're doing it in a way that is not getting you liquidated, that in a way that is not going to risk you being forced to sell that position, at least not if that position is of any meaningful size to you. There we go. As always, not financial advice, purely my opinion, just me yapping about the markets for entertainment purposes. But I hope you found it interesting. Plenty more to come. Catch you in the next one. Stay safe out there, please. Goodbye.